Good morning. We are sorry if we had some audio difficulties, so we are beginning again. Welcome to our presentation on the full or standard 203k loan. My name is Carla Ferguson, and I'm joined today by Shelley Collins, underwriting supervisor, who's had years and years of experience with this program. Our goal today is to familiarize you with this loan product and to take some of the mystery out of doing this loan. We realize this product isn't for everyone, but it certainly can be added to your arsenal and loan knowledge base. For the right clients, it can turn a fixer-upper into their dream home. Thank you for your patience, and we're going to get underway here. Now, this is a certification webinar. You must participate in the entire webinar, and because Shelley and I are the moderators today, we know you will not want to leave. You're going to stay glued to your computers. You have to pass the test with a score of 80% or higher. Your company must have passed the initial QC period, which is a minimum of 5 loans for wholesale clients only who have joined us on this call. Both the loan officer and the processor must have a Mountain West ID number to participate in the program. So as far as this particular product type goes, the training today is going to contain the parameters for FHA's standard or full 203k product. This is their primary program for rehabilitating and repairing single-family properties. This program can help you expand home ownership opportunities while at the same time helping to revitalize the communities that you currently serve. So let's get into the meat of it. What is a 203k loan and what can it be used for? Well, the full 203k can be used to purchase a dwelling and the land on which the dwelling is located and rehabilitate the property. You can purchase the dwelling on another site, move it to a new foundation on the mortgage property, and then rehabilitate it. And with a full 203k, you can also refinance existing indebtedness and rehabilitate the property for a qualifying dwelling, all in one loan. We're going to give you the whole full roadmap to the 203k, from pre-approval all the way through the rehabilitation process. We want to take the mystery out of this transaction. So let's go over the program basics. First of all, we're dealing with primary residences, owner-occupied properties. The borrower must occupy the property within 60 days of closing if the property is habitable, if it can be lived in. If the property is not habitable, it needs extensive renovations and rehabilitation. We can also mortgage, finance up to 6 months of the mortgage payment into the loan while the property is being rehabilitated. So your program code for this is FF30FK, which is the full K, and the ADP code for the processors on the line is 702. The eligible states we're looking at is Arizona, California, Colorado, Oregon, and Washington. Once again, we're talking about a 30-year fixed rate program only, and eligible property types would include owner-occupied one-unit properties, detached PUDs, and REOs. Now, ineligible transaction types are the following: 2 to 4 units, condominiums, manufactured homes, flips, ARM products, any self-help where the borrower wants to do the work. And we'll talk about this a little further in the presentation, but even if the borrower is a contractor or is a tradesman, we are going to want a contractor for this particular loan product, and any non-arm's length or identity of interest transaction. Shelley, you want to talk about some more of the program basics here?
Sure. In addition to those items that are ineligible, we're also not doing outbuildings, project conversions, converting the number of units. For example, if you have a 2-unit property that you want to convert to 1, we're not doing that. Partially completed projects. You have an issue with potential liens on the property from other contractors' properties in which prior owners started the work but did not complete, or refinances with incomplete work. These in-progress properties are considered on an exception basis only. And again, any non-arm's length or identity of interest transaction. Your maximum loan amount is up to $417,000, excluding your upfront MIP or whatever your maximum county limit is, whichever is lower. On your maximum loan amount calculation on a purchase, you have to look at the lesser of either the maximum loan amount of the sum of the sales price or as-is value plus the total rehab cost, including rehab fees minus any sales concessions, or 110% of the as-repaired value. We have to take into consideration the lowest sales price regardless of the entity over the past 12 months when structuring a loan transaction. And as we get into the program basics, we'll show you a worksheet that's going to make this max mortgage calculation much easier for you.
Now, when it comes to a refinance, you're going to take the sum of the existing debt plus the rehab costs plus any borrower paid closing costs, including prepaids, and you would subtract out any FHA refund credit if that is applicable. Or it's the sum of the as-is value of the property plus rehab costs, or 110% of the after-improved value. Once again, if the property has been owned for less than a year, you're looking at taking the lesser of the original sales price or the current appraisal.
On your program basics, minimum rehab costs. The minimum required rehab costs on a full 203k is $5,000 worth of eligible repairs. This is required by HUD. It needs to be there in order to do this. If you have less than $5,000 of repairs, 203k full is not an option.
Right. You would be looking at a normal HUD repair escrow or some other option besides the full K.
Correct. Maximum rehab costs. There's actually no maximum as long as the total base loan amount doesn't exceed HUD's county by county statutory maximum. And you can potentially do up to 100% of the loan for the rehab. If a borrower owns a property free and clear, but it needs renovation, they could basically borrow up to 100% of that new loan amount. We do not allow temporary buy-downs, and down payment assistance programs are not allowed on this program either. On the program basics regarding required reserves, there's no minimums required on one unit or detached PUDs. However, if there's a FICO score between 620 and 639, we are going to require 2 months of reserves. Cash back to the borrower. We cannot exceed funds paid as a result of the receipt of 100% of gift funds. So the borrower can get no money back at time of closing. Interested party contributions, the maximum allowed contributions is based on the lesser of the purchase price or appraised value. So on a primary residence with a FICO score of greater than or equal to 620, the max contribution is 6%. Qualifying the borrower. This is an FHA loan, so the documentation in the file must clearly support the applicant's ability to meet the financial obligations timely and responsibly. And it must meet all the normal FHA loan program guidelines. So you can refer to the appropriate section of either our 203k and FHA underwriting manuals, or the section of the HUD handbooks 4155.1 and the 4240.4 revision 2. Eligible borrowers. Eligible borrowers are basically the same as on a regular FHA loan. They have to have a valid Social Security number and one of the following residency statuses. They have to either be a U.S. citizen, a permanent resident alien, non-permanent resident alien, or they need to be purchasing via the inter vivos revocable trust in California. Ineligible borrowers are borrowers without a valid legitimate Social Security number, just like on a regular FHA loan. Non-resident alien or foreign nationals, borrowers with diplomatic immunity. We don't do loans to corporation estates, life estates, or partnerships, or not-for-profit organizations, schools, churches, or conservatorship. As far as qualifying the borrower, co-borrowers are allowed. Non-occupant co-borrowers are allowed, and co-signers are allowed. You get the green light there.
Now let's talk about credits. Your minimum credit scores for this product, first of all, they must go through an AUS, an automated underwriting system. So acceptable results are a DU approved eligible or an LP, which is loan prospector accept. The minimum credit underwriting score is a 620, and the maximum DTI is 50, which is pretty generous for a rehab loan. But again, this is going to go through an AUS and will be insured by the federal government. Manual underwrites, we're not going to allow it for this product. However, if you have FICO scores between 620 and 639, there's some additional requirements we have here. You must receive the AUS approval. The borrowers have to have a minimum of their 3.5% into the transaction of their own funds for the down payment, for scores within that range, 620 to 639. For the 620 to 639 FICO score, the ratios are capped at 31:43, no exceptions to the ratios regardless of AUS approval. And you would need 2 months reserves, as Shelley mentioned before, which is PITI plus the monthly MI and any HOA fee if applicable. Must be from the borrower's own funds, no gifts. So what type of improvements can you do with this loan? Well, it's just a ton of stuff to make this house into the dream home that the borrowers would like. This is a partial list. It's not all inclusive, but I just want to hit some of the highlights. You can change, like the second bullet, you can change the functions of the house, modernize it. You can remodel bathrooms, kitchens, permanently installed appliances such as built-in ranges and ovens. You can eliminate any health and safety issues with the home, including defective paint. You can change the entire aesthetic appeal of the home and eliminate any type of weird functional obsolescence. You know, this room you have to go through 2 rooms before you can get to a bathroom. You can totally reconfigure the home here. You can replace plumbing, connect to public water or public sewer if they are currently on septic or something like that. You can upgrade the heating and AC units. You can replace roofs, gutters, downspouts, upgrade electrical, painting, both interior and exterior. The purchase and installation of freestanding appliances is also allowed, including freestanding ranges, refrigerators, washers, dryers, dishwashers. You're seeing how the women in the transactions will really love this home when it's done with. You can improve it to make it handicap accessible if that need is there. You can replace and add exterior decks, patios, and porches. I mean, this is the loan for people who really want to make a fixer-upper into the home of their dreams. More things are itemized here. Again, as long as we meet at least the minimum $5,000 worth of work. Now, there are a few caveats here. For instance, when we're talking about shrubs and trees and sod, that cannot be in the first $5,000 requirement of improvements. Those need to be, you know, the main things to rehab the home. However, there are things that can be added when we talk about the appliances and things after that $5,000 requirement has been met. And even the repair of a swimming pool, as long as that repair doesn't exceed $1,500, if there's an existing pool, we can allocate costs to that. So this is a good thing, folks. Now, there are some things that are ineligible, and that's going to include any luxury items. So anything that is going to be perceived as a luxury item, like this little gazebo tub we have on the diagram here, any alterations that's going to support a commercial use, that they want to use a commercial business out of the home or refurbish it for commercial purposes, any recreational or luxury items, again, saunas, exterior hot tubs, etc., barbecue pits, dumb waiters, bathhouses, tennis courts. Come on, folks. This is an FHA loan. We're supposed to be providing, basic housing with some perks here and there. So, the satellite dishes and things like that, the borrowers will have to obtain on their own after they close the transaction.
Okay, so key parties in the transaction. Obviously, you've got to have a borrower. So what's the borrower going to do? They're going to go out. They're going to be looking for properties. They need to be pre-qualified by a certified mortgage loan originator who's going to explain the process. That's you. And the credit verification begins. You're going to pre-approve them just like you would any other time. They're going to meet with a 203k fee consultant to see if their ideas and the improvements that they want to do are within their budget, and then they're going to decide on the improvements. The buyers are going to choose a licensed general contractor to bid repairs on the potential purchase or refinance. And even if the borrower is a licensed contractor, they may not perform the work on the home. So who's the 203k fee consultant? Very key component and person in this transaction. So prior to the appraisal, this 203k fee consultant is going to visit the site, hopefully with the borrower and the contractor, to ensure compliance with program requirements, to make sure that the utilities are on and tested, and if they're not, he's got a condition for plumbing, electrical, and gas if they're damaged.
I almost view the fee consultant here like your quarterback in this whole transaction.
I would agree with that, Carla. He's very, very important. He's going to be our eyes, not just before the transaction closes, but also after the transaction closes.
Now, Shelley, we want to be politically correct, so it could be he or she, right?
Oh, that's correct. You're
okay.
Right.
Carry on.
The fee charged by the 203k fee consultant can be included in the mortgage as part of the cost of the rehab. The consultant will enter into a written agreement with the borrower, and the agreement is between the consultant and the borrower that completely explains what services will be rendered and what the fee charged is. And the fee charge is going to be based on a scale. So the borrower typically is going to pay the consultant up front, and it's going to be based on this chart. And the chart is based on the amount of repairs. So as you can see, you can go anywhere from $400 up to a quote of over $900 at some point based on the amount of the work. And occasionally there are renovations that are over $100,000. So re-inspections, if the consultant has to go out to the same unit, are $50. When there's additional travel distance that exceeds 30 miles round trip, a mileage charge, which is established by our local HUD field office, can be applied to the above charges, including toll road and any other charges where applicable. And so the fee consultant will discuss that with the borrower. In addition to that, what does the consultant do? The consultant's going to look at the cost of the contractor bids to ensure there's enough materials and costs are included in the estimate. During his inspection, he's going to make sure that all health and safety items will be addressed and added to the initial estimate. Any areas that were not accepted during a termite inspection will be investigated at this time as well. I've seen consultants crawl through attics, under houses, you name it, they've been there. They want to make sure they've addressed everything to protect the borrower and make sure everything's been addressed. The consultant is to be provided with a copy of a termite inspection if applicable. Not all properties will have that, but if needed, it would be provided to them. And he may require further inspections, including a structural engineer's report, a roof certification. And to get a complete list, where do you find a HUD fee consultant? You can visit this this link here on HUD.gov, and it will give you a list of all the consultants. What we did here at Mountain West is we decided to put together a list of local consultants that have been used previously. This is not by any means a required list that you have to use, but these are consultants that we are familiar with and do a good job in their 203k work write-up. So you're more than welcome to use these.
And in addition, this entire presentation will be posted on our internet, so you will have access to that and the links that we're going to show you today.
Absolutely. So who's the next party in our transaction? Well, obviously the appraiser. So what does the appraiser do? Once the 203k consultant has created what we call work write-up, the appraiser is going to be given that, and he's going to review the proposed improvements to determine if that will add enough value to the property and include in the purchase price plus the cost of improvements and financing closing costs. He or she will determine if the as-is price without the repairs is a fair market value of the purchase for the purchase. So if you have a purchase of $100,000, but he thinks the house is only worth $80,000, then he would indicate so on his appraisal. The appraiser must have experience with 203k loans, and here at Mountain West, our AMC has verified that the appraisers that are assigned to these projects do have that experience. The 203k consultant and the appraiser cannot be the same person. The 203k consultant, as I indicated, will give the work write-up to the appraiser at the time of the order. The appraiser will reference the work write-up and actually typically will copy the work write-up right into the appraisal. The appraiser does not have to add the repair conditions that are not noted in the, or excuse me, the appraiser does have to add anything that he notices as additional repair conditions to the appraisal. And the utilities need to be turned on and tested unless there's a condition where the plumbing, electrical, or gas can't be turned on because they're damaged. Case number is not required on the work write-up, but it is recommended. And then who's the other party that you have? Obviously the contractor. Contractor is hired by the borrower. I'm going to repeat that. It's hired by the borrower. Mountain West does not hire nor give the borrower contractors to do the work. They have to do their due diligence and find their own contractor. And that contractor is going to complete the work as specified in the work write-up. We've got to get proof showing that the contractor's license is valid for at least 6 months after the closing date. And why that's important is we want to make sure that as he's doing the work that his license hasn't expired and potentially could slow down the completion of the job. The number of contracts we're going to limit on this program is 1 general contractor and no more than 3 subcontractors. So you're going to either have 1 general or up to 3 subcontractors.
Okay, that is definitely an or, not both. Some people were thinking we were referring to 1 general and 3. You can go with 1 general, or if they're just going to use subcontractors, up to 3.
Absolutely. Contractor documentation needed. We need a W-9 form, which is going to be completed and signed by each contractor receiving payment. So if you have 3 subcontractors, you need 3 W-9s. Contractors fully executed bids, exactly the same thing. We need a bid for each contractor. A homeowner contractor agreement. We'll show you a copy of this a little bit more down in the presentation, but you've got to have that for each contractor, and the homeowner and the contractor both have to execute it. There's a form called a notice to contractor that needs to be completed, and at minimum, the contractor has to have a fidelity bond of at least $12,500, which is required by the state of California.
Okay, so we're continuing down our roadmap regarding this 203k loan. When you're ready to submit this loan for underwriting, first of all out there, you processors, you're going to process this loan primarily the way you would a normal 203B with the additional forms regarding the 203k added. But we have a checklist for you of the things that should be in the initial submission package. This is also on our website with all of the forms here included, so you can click on one link and all of these forms are there for you to print, especially those of you at our retail branches. So there's going to be the second check mark here, which is the FHA underwriting and transmittal summary. You're used to that form, the HUD form 92900 LT. the loan transmittal. But there will be also a maximum mortgage worksheet, which we're going to go through briefly today, the 203k acknowledgement, these certifications, which Shelley and I are going to talk about shortly. But we have included the checklist. We're going to show you the forms. It's not hard, and we have made them available for you on our website. So let's talk about the maximum mortgage worksheet. It's HUD Form 92700, and it is prepared at the time of the application. It should be provided to the applicant as part of the good faith estimate. It's going to set forth the components of fees associated with this rehab loan, and upon receipt, the consultant writes up the specifications, as we mentioned before, on the work write-up. By the time it gets to underwriting, these numbers are no longer an estimate. We know what the borrower wants as far as improvements into the home. So these are going to be more definite. We're going to talk about the need for a contingency and the inspections now. So this is how the form looks, the 2700. Put in all of your information into the loan origination system you're using. Point, many of you are using. Some are using other systems out there. Much of this information will populate over into this particular form. But I do want to go over some specific fields here. On line item A, which is the property information, you're going to have the as-is value of the property. Your appraiser will tell you what the as-is value is. That's the value before any rehab is done. The appraiser is going to tell us that on the appraisal report. And then the after improved value is going to be the final value that the appraiser is going to give a determination that once this work has been done, this rehab work, the property will be valued at XYZ. On line item A4, you take 110% of the after improved value, and that is what goes in that box. And as you can see in many of these categories, there are little notes to help you along the way. When you get to line B1, which is, our rehab and other allowable costs, that's where you put the total amount of repairs. So how much in rehab work that the borrowers, the consultant, and the contractor all agree to. That's going to be your starting point there. Then Mountain West Financial requires a 20% contingency. This is money, just in case money. If they have cost overruns or we have to go in and finish any work, it's going to be 20%. So whatever the rehab cost is, you're going to take 20% of that, and that will be the contingency that's required. What the contingency is, it's any funds that we need for cost overruns, et cetera, et cetera. Anything that's left over in the contingency fund after all of the rehab work is done will go toward a principal reduction on the loan amount. Or it could be used for some additional MWF-approved repairs. So the work is just about done, and then they decide they want to, Shelley, have an upgrade. Put in a patio.
And they've got $10,000 sitting there because they didn't use any of them, which is typically not the case. Almost every single 203k transaction that we've done here, at some point or another, the borrower has used a portion of the contingency reserve. However, mortgage payments can't be paid out of that contingency reserve. That is one of the items that doesn't.
That is an important factor. Now, looking at our maximum mortgage worksheet again, item 4, it says mortgage payments escrowed. If the property is not habitable when they close the loan, the borrowers can roll in up to 6 months of the mortgage payments. Then the payments can be made on the loan while the property is being rehabbed. That's only if it's not habitable. Now, your consultant, everybody will agree as to how long it's going to take for the rehab work to be done. So if based on the rehab that they've chosen, it only takes 4 months for the work to be done and the property is uninhabitable, then we will roll in 4 months worth of the payments. If it's 3 months, etc. but many times the borrowers can live in the property while it's being rehabbed. Then if the consultant's fees, which Shelley went over, would go on line 7. The consultant fees, again, will be based on the amount of rehab work. It's on a sliding scale. If any permits are required, then the amount of that would be on that line. Now remember, your consultant, fee consultant, will provide all of that information as part of the work write-up. Discount points. If there's borrower paid discount points, I want to go over briefly an example as to how this works with a 203k loan. Because say this is just an example here, there's 2 discount points on this transaction. The borrowers can finance a portion of that with the remainder being paid in cash. So let me give you an example here. So the discount points that they're going to finance have to be equal to the number, the total discount points on the whole loan. So if we had this loan amount here, $234,983, and we have line B10 equal to $72,772, the discount points on that 2% discount on the total loan would be $4,699.66. Now, the borrower can finance 2% of that based on the total rehab cost. So 2% of the $72,772.12 they could finance. Then the remainder, which is the difference of $3,244.22, that is what the borrower would have to pay in cash. That would be the cash discount points, or the rest of the discount points, with the $1,455.44 being financed with the borrower paying the difference. So the main thing is, with discount points in a 203k rehab loan, the borrower can finance a portion of that and then pay the balance in cash. Now, moving down on this form, you're going to have your sales price, now adding your total rehab cost to that, and you're going to get a subtotal there. That's really like your total acquisition for this. You multiply that by your 96.5%, and that's your base loan amount. Pretty easy, right? So we started with the rehab cost and what could be financed, but when we get down here, we take our sales price plus all the rehab costs, and then you use your normal factor for maximum financing with FHA loans to come up with your maximum base loan amount. Here is the 92900 LT, your underwriting transmittal. Just some reminders, have your case number on here, including the ADP code, which is 702, not 703, for a 203k loan. The SOA is the section of the Act which you will fill in as 203k. Under the loan purpose, you always need to check everything that would apply to the loan. So in this case, it would be a purchase plus it would be a 203k loan. So both of those items need to be checked. On your 1003, your final 1003 and the details of transaction, here again is your purchase price plus your rehab cost should be on item B in the details of transaction. Processors out there, always do your maximum mortgage worksheet first, then do your LT and your final 1003. Start with the maximum mortgage worksheet. Make sure you have all your costs and your total rehab together before you go to the normal basic FHA form.
Okay, so lots of new and different forms on an FHA 203k as compared to a regular FHA loan. We've got what's called a 203k borrower's acknowledgement. It's your form 92700A, and basically this form is important. And I encourage you to read the full form, and I encourage you to make sure that your borrower reads this full form. But one of the things that's important about this form is the section that we've circled here. When we finance the cost of the repairs, where do those funds go at time of closing? Those funds go into an escrow rehab account that's held here at Mountain West. And because of the fact that it is an escrow account, we are required to pay interest on that money in that account during the time. So this form will actually tell Mountain West how to disperse that interest once the loan has been completed and the rehab's been completed. So they're either going to check, pay the net interest directly to the customer, apply it to the principal balance, or other, and I've never seen other. So good idea to read it. Identity of interest. HUD wants to ensure that there's no identity of interest issues between any of the parties participating in a 203k transaction. So the applicants and the consultants must sign and date certifications, which was on the checklist earlier, that for all loans and credit applications, and they have to be in our case finder as well. We've given you an example here of what the borrower's identity of interest certification looks like. And again, you can see it says, you know, a couple things, that there's no identity of interest between the realtor, lender, contractor, consultant, or appraiser, and that they will or will not intend to occupy the property. And since FHA requires owner-occupied loans, 203k, this needs to say we will occupy the residence. And of course, it has to be signed and dated by all. Same thing with the consultant's identity of interest certification. Same thing. He has to sign and date this. Homeowner contractor agreement. This is basically a written contract between the homeowner and the contractor. It's required on all 203k full-blown loans, and it indicates who the contractor is that's going to be completing the repair work. In this form, it actually indicates that the contractors will have a 10% amount held back for each invoice payment request amount. So on the homeowner contractor agreement here, you can see it's got the owner's name, the contractor's name, all the contractor's tax ID number, address, and everything. In this amount, in this form, you're going to have to complete that the owner shall pay the contractor the sum of his contract for the completion of work, which should match with the work write-up, which should match with the bid. And it has to be signed and dated by the owner and the contractor. Specifications of repairs or the work write-up. Once this is completed by the consultant, and it's going to look primarily like this, but they all have different formats, but for the most part it's going to look like this. The underwriter is going to be satisfied that the estimates provided, the bids provided are in line with the consultants, and that the bids, the homeowner contractor agreement, and the work write-up all must match. So as processors and originators out there, you need to be looking at these things, make sure they match before they come into underwriting as well. Contractors fully executed bids. We already know that the fee consultant is going to go out and be inspected, hopefully by the consultant, borrower, and the contractor to determine the work that needs to be done to have the home meet minimum property standards, and for what the borrower wants to have done to the property. So once the bids are completed, it should include all the repairs that are listed on the specification of repairs that the consultant has given. It needs to include contractor's name, address, license number that can expire for a minimum of 6 months during the rehab period, their phone number, borrower's name, subject property, total amount of labor and materials, how long the job will take, and completion date, because on a full-blown 203k, they have no more than 6 months to get the job done, and it should be done much quicker than that, unless it's just a very big job. And of course, the contractor and borrower's signature. So the final dollar amount, again, everything must match, and upon receipt of the accepted bids, we're going to check throughout on the state contractor licensing board. There's actually a link they can go out and just validate whether they whether it's current and whether it's going to be valid through at least 6 months after closing.
And as Shirley mentioned, these can go pretty fast, or it can take the full amount of the allotted time. Remember, they could even take a house from one location and be moving it to another location. So this is the house, once again, that they want with all of the improvements and amenities that they are choosing.
Okay, so another form that you're going to see is a draw request and inspection form, the HUD 9476A. This is a form that will be completed by the 203k consultant after meeting with the borrower and the contractor. It will include everything that will be signed off and the work that it's going to be done. So it's going to correlate with your work write-up or specifications of repairs that was initially completed. When the consultant goes out every time to do an inspection to release money to the borrower and contractor, he will complete this, and it's his opinion of what has been completed in a workmanlike manner. This is the second page of the 203k consultant draw request form, and on here there's some sections: the draw inspection, the contingency reserve inspection, final inspection. Sometimes there's a change order. When the borrower gets into the transaction and decides that, you know what we thought was going to work isn't going to work, but we're going to change it out, they've all got to agree, the contractor, consultant, and borrower. We don't recommend change orders, but they do happen, and this form will help to initiate that request. Once the loan closes and the contractor has requested a draw, like I said, the 203k consultant will set up an appointment with the borrower and the contractor. They'll walk through. They'll all agree on what work has been done in a workmanlike manner, and then they'll all sign it. And they'll send this form in to our 203k specialist that handles the draw request, and that's how the money will get dispersed. The W-9 form is required by the contractor and or contractors, up to 3 subcontractors if you're using subcontractors. And we have to have that. It is required, and it's needed from anyone who is going to be receiving funds from the loan. So each contractor has to sign the W-9 form. It has to be filled out accurately. And then the notice to contractor. This form is so important, and I've got to just make this real clear to you. Contractors sometimes will want money up front. On the full-blown 203k, the contractor cannot receive any upfront startup costs. So the borrower needs to understand that too. That's why they need to do their due diligence when they choose a contractor, to make sure that he's a viable contractor, that he's got the funds to start their transaction and follow through all the way through. One of the things that it does say in here, that when we issue a disbursement to a contractor, we are always going to hold 10% of a disbursement on each one. They will get that money at the end when the final draw is done, but we hold that 10% just in case. We want to make sure that the contractor is going to complete the job. The disbursements are going to be made by a two-party check to both the contractor and the borrower. And we've already discussed what they need, so pretty much they just need to acknowledge they understand the rules around this.
Now when it comes to the contract, the purchase agreement, you need to make sure that on your standard contract that it indicates that a 203k loan is being obtained. So on your page 1 of your standard CARS form, you see there is a section for other. You can write in or type in 203k loan, the agent, or they can choose to put it under item D in additional financing, under additional financing terms. If it is a HUD REO that's being sold, the HUD contract itself has a specific box to designate that the financing option is a 203k. So we've indicated that for you here. Now when it comes to the appraisal, the all-important appraisal, the appraiser is going to indicate somewhere in the comments section or an addendum on the appraisal what the current as-is value of the property is. So we're only dealing with one appraisal for the 203k loan here, which is a great thing. Like in this example here, the appraiser has stated the estimated as-is value of this property is $115,000. But then on the page where they give the current value, that is going to be a value based on the rehab work being done. So the appraiser will indicate that this property, this transaction is subject to the following repairs. The appraiser is not going to list the repairs, but refer to the work write-up or state that the repairs as described in the attached bids or in the attached work write-up or specification of repairs, because the appraiser is agreeing with the repairs that the borrower has chosen that have been agreed and confirmed with the 203k consultant. And then the appraiser is going to say what the after improved value is. This is the value based on the rehab being done, even though it hasn't been done yet. Now, these are just some FYIs for those out there who will be potential underwriters, or just an informational thing as to what the underwriter completes. The underwriter completes a form called the Mortgagee's Assurance of Completion, telling HUD that work is going to be done after the transaction closes. They complete the conditional commitment, which is the statement of appraised value, and they finalize all the numbers on that maximum mortgage worksheet that you sent in. They're going to sign and date the form, and they're going to make sure that it goes out for signature to the borrowers when we send out loan documents. So this is just a quick peek as to how the HUD Mortgagee's Assurance of Completion looks, the top portion of it. We're going to refer to the work write-up, and then the statement of appraised value, or what underwriters know as the 5B.
Notice to borrower. We have several different forms, as you've seen, with the 203k. So like our rehab loan agreement, which I don't think we've shown you yet, and the 203k borrower acknowledgement, there's some real critical aspects that apply to the loan and the borrower during the rehab construction project. So it's mandatory, and it has some HUD required language which is necessary to have the loan insured. So again, I highly recommend that you go through, you read this. It has a lot of good information in it. This is just a portion of the actual form. The form is actually longer than this. On your 203k closing documents, in addition to your standard FHA closing documents, we're also going to include in the closing package an interest rate on the 203k repair escrow account form. What that does is it advises the borrower that they'll receive a 1098 statement and the rehab loan agreement and a deed of trust with a rehabilitation rider, which basically indicates that we're closing this loan as a 203k and there's going to be rehabilitation done. The interest rate on a 203k repair escrow account advises the borrower that we're going to set up an escrow account here at Mountain West Financial for their benefit. That's where all their escrow funds for the loan are going to be held, and that we will report any interest income that's earned via a 1098 interest statement, and that amount of interest earned will be reported to the IRS. It basically says, we understand that our 203k loan will be serviced by Mountain West Financial Incorporated, and the money reserved for the repairs on our property will be retained by Mountain West Financial Incorporated in an interest-bearing account at a rate of 0.01% interest. This amount of 0.01% interest will be paid to me when all repairs are complete, and then the borrowers will acknowledge and sign and date it. The rehab loan agreement, which is part of the legal documents of the 203k loan, is an agreement between Mountain West and the borrower that's established that Mountain West will advance the 203k mortgage proceeds as the work is being done. And this loan agreement is incorporated by reference and made a part of the security agreement on the loan. The deed of trust with a rehab rider. Here's an example of what the rehab rider, and it basically indicates that we are advancing funds on the premises with this rehab loan agreement, and that everyone is in agreement that Mountain West is going to hold the funds, and the funds will be released as the work is being done.
But again, Shelley, that rehab loan agreement and rider automatically goes out with docs from us.
Correct.
This is just informational for you out there, because many of you go to the signings with the client, so we would want you to know what this is in case the client asks you or has any questions. Now, at the time of closing, the following fees will be dispersed. The consultant fee, any permit fees will be dispersed, any architectural or engineering fees, also any title update fees. Again, the renovation funds at that time are put into that interest-bearing account. Moving on our roadmap here, we're going to talk a little about inspections. When the loan funds or closes, the borrowers will receive a 203k guide package, just guiding them through the process as to what's going on. It's very informative. It's put together very well, and if they have any questions, they will be conferring with our analyst that we have here. The draw process is currently handled by our Mountain West Financial 203k analyst that is here at our corporate office. There are a few things we want you to keep in mind. The loan funds up to 5 total draws. That's 4 draws plus the final draw. All the checks, as Shelley mentioned before, are two-party checks. Anytime a draw is made, it's going to be payable to the borrower and to the contractor. That's why we really want everybody on the same page as they're choosing the rehab work to be done. And title endorsement 122 is ordered at the time of each draw by the 203k analyst, which is why we advance those fees at time of funding. And some helpful hints, we're almost done here. Make sure all the parties understand the draw process. If there are any permits involved, those need to be required by the time of the first draw. Title has to be clear before final payment is made, and if the borrower or the contractor changes the scope of the work after close or during the rehab process, it could cause delays. Again, we usually have everyone meeting together on the same page so that they do not have major changes during the process. And the contractor or borrower must have funds available to start the renovation. We provided you with some helpful links here, the underwriting handbook and also the 4240, which is the rehabilitation handbook out of HUD. We invite you to check out these different websites. They're very helpful with this type of transaction. In addition, feel free to contact your 203k specialist at Mountain West Financial, which many of you on the call will become a 203k specialist after listening to the presentation today. Or you can email any 203k questions to us at 203kquestions@mwfinc.com, and we'll get back to you with any specific answers on this loan product. Once again, we thank you so much for attending today's presentation. We hope this information has been helpful to you and helps you to bring your customers one step closer to home ownership. And I invite you all to stay tuned for the link here to the certification quiz. Good luck. No password is required. And we look forward to your future 203k loan submissions to Mountain West Financial. Thank you very much. Have a good day.